quick programming note. We are not going to talk about sports. We are not going to talk about Dennis being tired from that exciting double overtime victory. We are not going to talk about AB's failed parlay with like giving up, winning by 2 goals, and will Lady be, wear a red shirt in the second row or something like that. No. We're going to talk about the price action in Nvidia. We're going to talk about the sell-off yesterday. We're going to talk about blowout earnings in Deckers and ROST stores. And we're going to set things up for this Friday not an expiration, but Friday, 3-day weekend here. Pre-market prep gets started right now.
Welcome to Benzinga's Pre-Market Prep.
This is a volatile puppy here.
It's all about execution styles and strategies.
All right, Gabe, this is not a t-shirt. This is one of my many new Michigan National Championship shirts. Nice and thin because it's going to be 85 degrees here. So it's not a t-shirt. It's a polo. Straight up from that open big sell-off yesterday, creeping back into the 5,300 handle, trading at the highs of the session at 5,301. Buck down 24 cents at 104.60. TLT flat. Sold off yesterday, but flat today. We have crude in the 76 handle. Time for OPEC to do some cutting. Down 19 cents, 76.58. Gold, a little rebound from yesterday, slacking. Up 320 at 23.40. Silver, up 26 cents at 30.72. And Bitcoin, trying to get back into the 70K handle. Up $320 at 67,500. And triple 525. Let's bring in a happy Triple D.
Happy and tired. Happy and tired.
What time did you go to bed?
Oh gosh, the game ended around 12:45, and then you're just wired from it. So like 1:30, probably like 1:30, and then you got to get up. And I slept in today. I usually get up in the 6s to trade, and I was like, there's none of that. So I didn't get up till 7:30 here today. So I am late. So I'm listening to Pre-Market Prep for you guys to inform me today on what is going on here. So bring in AB, because I know he was up late, even though his parlay didn't work out. I know, but he's young blood, so he'll be good to go here. AB?
I am good, even though my parlay didn't hit, even though it's a Friday. I'm here. We've got, we've got some market news to break down. I think, so we had some earnings to go through, but before we get into that, there's a couple things I wanted to talk about. First of all, if you would have told me Nvidia closes up around 10% after its earnings report, I would have guessed the Qs closed up around, I don't know, say 1.25%. I would have guessed the S&P 500 closed up about 0.75%. I would have thought even the Dow finished higher. Yeah. Well, that's not what happened. And I said what it reminded me of is like when a company reports a good report and then it ends up selling off and you're like, okay, this feels a little weird because, they reported good numbers. Like, why isn't this up? And so I don't know. I'm not saying that, like, I think yesterday was the sign that the market's topping out, but if the market was in this like exuberance mode where everything was super euphoric, I think it latches on to something like Nvidia's strong report and closes up significantly higher. That's not what we saw yesterday. So it was a little bit worrisome to me just looking at like the overall market.
Yeah, very worrisome for the overall market. What we had was a key reversal in a lot of stocks, not all stocks, but in a lot of stocks yesterday. And it really started from the open. We were somewhat concerned, and I actually tweeted out at 9:45 yesterday morning, I'm like, the non-AI stocks are getting smacked. And this is what happens. You have the opening, everything opens up, everybody's excited for Nvidia, they're buying stocks across the board. And then there's buyers strike on everything that is non-tech, and it goes especially non-AI. So what they're doing is taking money from all the value sectors and, maybe by buying Nvidia, maybe they're buying some other stuff, but there was just selling across the board in the value sectors. But then it started to spill over, and Joel had the timeline really well. We talked about this on the closing print. I believe it was 9:45, Joel. Yep. EMI came out. It was a little bit hot. So we already had a value sell-off in the first 15 minutes. So we got a little bit of hot data, like, oh boy, that's not what That's not what the value stocks need. We know they want lower interest rates. You weren't getting that. So then IWM starts taking a bigger hit. Value stocks start taking a bigger hit. And then, Apple, obviously, with the negative correlation that we talk about a lot, was already trading down to open at its high print and started selling off. So there was broad market sell-off happening before. And then you get Fed speak in the afternoon, and it just accelerated. I believe it was Bostic, or I think it was Bostic. I'm getting all confused.
Yep.
But talking about possibly needing more data and hinting that we may not lower rates at all this year. So, I mean, that just snowballed and the selling just continued in everything except Nvidia. When the dust settled, I looked at my screen at the end of the day. Stocks like AMD and MCI were way down, and they were up almost as much as Nvidia early in the morning. The only thing really holding up was Nvidia.
Yeah.
So again, best of breed holding up Nvidia, which is the AI revolution that it is, but unbelievable selling pressure in a lot of other stocks. Not good news really for the overall market.
I just thought it happened a little bit in the pre-market. Like I noticed like a 10 handle leak, and you don't want to get like all excited, right? I mean, we're up 30 handles, and so you have that kind of open, and what the game plan, be on those kind of opens is, maybe there's like a 10-15 minute pullback, right? They shake some people out, and then they go back to the pre-market high. So I mean, I had some areas of support, where the old triple top was. I thought, okay, there are going to be some buyers there. I mean, I wasn't even in it for like 5 seconds. It just cut right through that. And that was even before the 945 number. And then the 945 number came in with the second red arrow. They didn't that with the PMI data, 50.9 versus 50, S&P Global Composite PMI, 54 versus 54.11. I mean, they're hot. And then you couple that with what was said in the Fed minutes, then it changed the complexion, and it just caught everyone leading the wrong way. We talk about the importance of the opens. Dennis and I, went over several stocks, and I mean, Apple 190.98, high 191. So not necessarily being right, taking a stab on those trades, but at least off the open, get a good indication, where the big money is. So good sell off, like the worst day in the Dow in like 100 years or something. And but we got a rebound going this morning. So interest rate fears once again rip the market.
And nobody should be surprised at the sell-off in the value names, because we've seen this script before. When AI stocks start getting a bid, then you start seeing other sectors take a hit. Nobody should be surprised at the staples sell-off, where we really were selling off in the utilities, which shout out to Mark Chaikin. Great call on our show day before saying staples overbought. I mean, again, these are the stocks that they've been buying across the board here lately, with the IWM comeback, with a little bit of the rally in the TLT, and that turned yesterday. So some profit taking. Is it, cause for concern? Are we going into a recession? Is this it? Was that the top? I don't think it's the case. I still think you're buying good companies at reasonable valuations on dips. So have your shopping list ready. But what I think going forward is it's not going to be the staples, and again, it's not going to be companies like, and it all depends. Like Boeing gets hammered.
Oh yeah.
Absolutely hammered. Well, ask yourself this question: is Boeing still a good company? I mean, yeah, they have the duopoly. Yeah, but I mean, they've done so many things wrong. Management just terrible here. I mean, until they get new management in there, a new CEO, it's hard to say that, yeah, Boeing's the company that I want to buy on the dips. A lot of those names are getting hit. So the underperformers getting hit. The Cathy stocks, ARKK, having a terrible day. Again, it's amazing to see that, a person who invests all in tech stocks and the Q's sitting up at all-time highs, yet, ARKK can't even make a new, 52-week high, can't even make a new high on the year, actually challenging and getting down where she's almost down. I think she is down on the year. That's impressive. It's been a really good market. It's very impressive to be down on the year. You got to be really bad at picking stocks to be down on the year.
Let's just mention what also is went on recently that's kind of symptomatic of a potential top in the markets. What event took place over the last couple weeks that he's like, Maybe things are getting a little frothy. Do you all remember what happened a couple weeks ago?
I don't remember last night half the time. I
You
just remember
guys
the Oilers
remember
won.
this? I mean, come
hold on.
on.
Let me think.
Goldfish memory, Joel. Goldfish memory.
Come
I have
on,
no
this was
idea what
such
happened
a
2 weeks ago.
occupied like 2 or 3 shows.
Clod witching.
No, that's in June.
Quad witching.
That's in June.
Uh,
Mary's on top of it.
Meme stocks?
Yeah.
The memesters?
Yeah.
Oh my gosh, GameStop too. Hammered yesterday. GameStop absolutely hammered.
Really?
Roaring Kitty rally has fizzled out. We still don't know if it was indeed Roaring Kitty or not because we haven't had any confirmation that that's still his account. So, I mean, across the board selling in a lot of stuff. The only thing, if you were hiding in Nvidia, you were pretty happy yesterday. If you're hiding in anything else, even AMD getting hit, I'm an AMD, so that hurts there too. But, this GameStop rally, they just don't have legs. And, what about Snowflake, Joel? Moving away from that.
Wow.
Talk about the bag holder trade. The bag holder stocks, which meaning the stocks that have been going down on the year, the stocks that have been underperforming the market, those got hit the hardest yesterday. The catch-up trade got hit the hardest yesterday. It's been the Momo trade. Some of the Momo stocks, were actually holding up, like Nvidia, obviously. But for the most part, mega cap tech, got hit yesterday. And yeah, it was an ugly day for Microsoft. But really, sold off $3, $4. It didn't even sell off, nearly what the overall market did. What's got hit yesterday was the catch-up trade. What got hit yesterday was the interest rate sensitive stocks. What got hit yesterday are the stocks that have been underperforming. Maybe it shouldn't be in the underperforming stocks.
Another move that, looking at yesterday's action that, surprised me and I think is worth talking about. Do you guys see how much ELF closed up yesterday? Closed up nearly 20% after when they reported earnings Wednesday night.
Down $20.
Down to when was the last time you've seen that in an earnings report where a stock went down $20, which is what, like 9% for ELF, and then ends up closing up 20%. Like I was trying to rack through my brain and trying to remember. I remember sometimes there had been, I feel like in the tech sector, you had some companies that were trading higher by like 5 or 6% in earnings. Then by the time the day closed, the next day it was down 10%. But I've never seen a company get bought back this big after the report. Like, I don't know what. Were people that poorly analyzing the numbers that they thought, okay, this thing's going to crash, sell, and then they were like, wait a second, these numbers were actually pretty good. Buy. Like, how do you miss it by that much?
There are some head fakes and the other. So we actually saw this yesterday, AB, in the opposite direction with Snowflake. The exact same thing happened.
It's the exact same thing. It would go in
the mirror image of it. Snowflake, bring up Snowflake's chart from yesterday. It's the mirror image of it. SNOW was up $20. You can see the tick up to like 185, and it turned around, gave it all back, and then not only closed down $7 or $8. So impressive, maybe not to the extreme of ELF, but pretty to the extreme. I mean, we see these earnings reversals from time to time, and they become more common. And I think what you have is, people caught, maybe the bots are caught, and they're like, oh yeah, we're hitting this. This looks good. And then they're caught, they're scrambling to get out. Liquidity is lower. Then you have the earnings reversal. Then you have media grabbing a hold of it and saying, oh, but look on the report here. If you dig down in the weeds here, you'll find, that there's a little something hidden under footnote 972, and that's just media trying to find a reason. Meanwhile, it's just an earnings reversal. So earnings reversals are a lot more common than you think. Now, again, we talked about ELF yesterday too. We talked about Snowflake having bag holder central, so it wasn't surprising that eventually gave it back. ELF, we talked about just, being a name brand. We compared it to Celsius, where these name brand stocks often are prone to stuff like this because the buyers come in and they can't help themselves. So good companies with reasonable valuations. ELF's a fantastic company. I'm not sure the valuation is reasonable, but the brand has just been unbelievable.
Well,
the growth has been unreal.
The growth has been unreal. So the valuation, if you think it's going to continue growing at even like 50% of the pace it has been, and the valuation makes sense. If you think the growth is going to slow down, then the valuation is a little rich. I thought the only way a stock could do something like this on earnings is if I were holding puts on it, right? If I bought puts on ELF and I see it trading down 10% after earnings, I'm like, oh yeah, I'm about to make some money tomorrow morning. Let's go. I'm about to make some money. And then I wake up the next day and it's up, 20%. I'm like, wait a second. I went out last night to the club and I already spent all the money that I thought I was going to make on these puts. Now I'm even further down in the hole.
That thing traded down to 130. Was it 135, 136 in the pre-market? I can't even get how low that was. 135.07 that traded down to. Wow, what a move in Elf Beauty. But let's look right instead of left. It's traded up $1.63 today. Holds that earnings gap. I mean, if there's any bit of people caught.
Now hard for that stock to go back down now. Because everybody's caught from yesterday on the wrong side, caught with their pants down. The caught with the pants down trade. That was yesterday in a nutshell. Caught with your pants down. Let's buy AMD. At one point in time, and I'm long AMD, talking about, but at one point in time, AMD was up more than Nvidia. I was like, holy, AMD's up 8% here right now, and Nvidia was up like 7.5%. I'm like, and AMD didn't do the split. AMD didn't announce the awesome earnings. AMD didn't. It was like crazy chasing the AI trade. I'm like, AMD at one point in time was up $173. I'm like, Nvidia was the one that did it all. I'm like, that was impressive that AMD had bought that much. And then caught with the pants down trade. Everybody who chased that in the morning, boom, 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 boom. And they're like, it's down. Well, it's got to come back. No, it doesn't. Now they're caught again. So, I mean, that's what yesterday was. Everybody chasing off the open, punished severely. Do not chase stocks. We're not in the environment. We're not in 2020 anymore. We're not in Kansas anymore, Dorothy. Do not chase stocks. Not in this environment.
So yeah, I mean, obviously yesterday's big, everyone was talking about Nvidia. We mentioned the move in ELF. Let's get to some of the earnings that came out after the close yesterday. So the first one, we'll stay in the retail space because we were just talking about ELF. Let's go to DEC. Deckers reported earnings yesterday after the close, and the numbers, I mean, were great. So EPS came in at $4.95. The estimate was $2.90. So they almost doubled up the EPS estimates. Sales came in at $959 million, beat the $887 million estimate. The guidance came in. The market liked the guidance came in. They said they see fiscal year 2025 EPS at $29.50 to $30. Versus $30.29 estimate. So actually that guidance came in a little bit lighter, but I think because the numbers were just so strong, they overlooked that guidance. And you had a bunch of analysts coming in this morning. Bank of America Securities, KeyBank, Telsey Advisory Group, Stifel, Baird, all upgrading their price target on Decker. The stock is trading higher. What are we at this morning? I haven't even looked.
It's up huge. And you know what I find interesting too is when yesterday's sell-off, everything getting hit. Look how much Deckers sold off ahead of that report. Look how much it sold off.
Nothing.
And you know what? This is a loved stock. And again, maybe it was COVID that turned this whole company around, which probably was, back it was $200 and just kept going and going and going. But again, this is just a name, a company that is obviously firing on all cylinders, but a loved stock. And they didn't sell off 600 Dow points. They're hitting value stocks. They're hitting retail stocks. They're hitting everything across the board. Deckers? No, we don't sell Deckers. I mean, that's interesting in itself. So Deckers.
Sorry, go ahead. I was just going to say, someone in the chat was asking what Decker does. Deckers is the parent company for Hoka as well as Uggs. I think they own a couple other brands, but I think those are the two big ones. Hokas are those running shoes that have like a bunch of foam and stuff on the bottom. You'll see them, and they look like kind of clunky looking, but
I got a pair of those.
Runners love them. Like nurses, people that are working on their feet all day love them. Yeah, and then Uggs has made
swimmers even like them.
Yes,
I don't. Oh, I got some Hug pool shoes too, Dennis. Yeah, I do.
You do.
You got some
pool shoes. Okay, stop.
Wait,
what are pool shoes?
Hoka flippers.
Flippers? Are you talking flippers?
Yeah.
Well, I have two sets of flippers.
Okay.
I have.
Are pool shoes different than flippers?
Yes.
What do pool shoes do for you?
Pool shoes are shoes that you wear to the pool.
Why do you need pools in a pool? Why do you need shoes in a pool?
Not in the pool, but to go to the pool.
Oh, to go to the pool.
Are they
you
like
don't get the
flip-flops?
cooties from the other people all over your feet. I get it. Okay.
Yeah.
I meant like swimming in the pool with your shoes on.
No, I have two. I have big fins and then I have these things that are called Zoomers. But when I go to the
Big
pool,
fins.
yeah, big fins. You can like kick really fast and not use your legs as much. But when I go to when I go to the pool, I put on either my I think I don't know where my Hokas are, but I also got some. I think they're called Uvus or something. They're super comfortable. And then then you got to get your Tevas. I probably have I don't know how many pairs of pool shoes, but no Crocs though. I did go to DSW with Lisa, and they had a Croc selection. Oh my lord, I was tempted. I mean, they got more. They got more than the shoes with holes in them. But the only thing about Deckers is, man, the Uggs. I don't understand winter shoes that you can't wear in the winter, right? Because of the material that
Yeah,
you know what I'm talking about?
I think it's more of just like a fashion thing, and they've come back, and Uggs has made some like this past season there were women wearing like platform Uggs, so like Uggs that were made you a couple inches taller and like this and that. It's just weird because Uggs, like the original Uggs trend fad was in what, like 2008,
Still here.
2010, and like remember when Tom Brady was in the commercials and people were making fun of him, being like, "Oh, you're in these girly shoes commercials," but like Uggs are still around 15 years. It's kind of like Crocs, where it seemed like a fad, but then next thing you know, it's 15 years later and people are still buying them. But an incredible move in Deck just over the last year or so. I mean, if you look
Been an
at
awesome stock.
the 52-week low is $424. It's up to $900. And here's what I have found really fascinating about the market the past few years, because obviously you had COVID when everything was going higher. Then the past couple years, you've really been able to notice which companies are doing well, which companies are taking market share from competitors and reporting good numbers. And there's been a lot of opportunity in the retail space where everyone's going to be focused on finding the next Tesla or finding the next Nvidia. And like those are the companies that will always get the most media attention. But there have been strong opportunities, whether you're talking Abercrombie and Fitch, whether you're talking
Celsius,
whether you're talking Celsius, and just understanding consumer trends, which to me, I feel like that makes a lot more sense to me. Like, hey, people are buying this product, the company should do well, versus trying to understand like the technical aspects behind SMCI and AMD. It's like that stuff's going to go over my head. I can understand some consumer trends. So like the Chris Camillo type of investing where you really
I mean, that's Chris Camillo and Dumb Money, we give them a shout out. We know those guys well. Chris has been on the show lots of times. I mean, that's what they do, and they do it well. Chris does really well with it. They're just out there looking through social media. They're trying to find, he calls it social media arbitrage.
Yep.
Trying to find what people are talking about, trying to find the consumer trends, trying to find the next best thing. And I mean, sometimes, they don't work, but, like the Barbie trade, he was all over the Barbie trade. We were on the Barbie trade too.
How was the Barbie trade?
It worked out really well, actually. Mattel went up, and then it's classic, buying and running up into the movie, and then death.
It worked out if you knew when to sell.
Well, when to sell on these things. Like these things are before the movie comes out, before the buzz. You're into the buzz period where they can't stop talking about it. It's the run up into the event. That's my trade. I mean, the Barbie movie was an event for Mattel, and it's the run up into the event and the sell off after. So, I mean, that's how you trade these things, is the run up into the event. Once everybody else is talking about it, then it's probably too late. But you get, it's just that catch up where everybody starts talking about something. And then, that's, the time to be buying. And then once everybody's already talking about it, once CNBC starts talking about it, that's the time to sell.
Dennis, I want to just talk about this Deckers for a second here, because it's $1,000 stock, right? It's up. So, and this is just maybe a lesson in order execution or with the markets. It's so hard to give levels here, right?
Yeah.
Because it's a thin stock. But this is just a hypothetical situation here, and maybe so please, but what if you were long 5,000 Deckers right now?
Okay. Not very many people are long 5,000 Deckers unless you're running a hedge fund, but
okay, let's say you're
a lot of money.
Let's say
what if you're long 500? What if you're long 500 Deckers?
Okay, what if you're long 500 and your target is 960? I'm just giving a hypothetical situation here.
Sure.
What would you just? I mean, could you even throw out 100 shares right now? Could you throw 100 shares out?
It's wide. So right now it's $20 wide, $20 wide. $1,008 to $1,019.80. There's a couple odd lots here. And I sometimes have this issue when you get up there, not that I have 5,000 deckers, but in some cases, like I feed them out. Like if again, the $1,000 stocks, you got to trade them a little bit, and here's a lighter lesson in execution. Sometimes I'll go at it with odd lots, like 98 shares, just so I'm not throwing out. Because if you go under 100 shares, your offer doesn't show up on the consolidated quote. So you can throw out like 98 shares and then you're not walking it down. So, if I've, got even 500 shares, let's say of something like that, I can 98 it, and try to just slowly feed it out. Because if you throw out 100 shares at 10.14, then somebody's at 10.13, 80, 90, penny jumping you. And then the algos are sitting in front of you. So sometimes it's best on these higher price stocks to throw out the odd lots. And a lot of you traders listening to this show probably are only trading it with odd lots. I mean, it's $1,000 stock. So, to have 100 shares, you got to have 100 grand. So, I mean, it's, sometimes, easier to trade these things with odd lots. So if you're already in odd lots, then you're at an advantage over the institutional trader that's sitting with, 5,000 shares. To your point, Joel, you're an institutional trader and you're like, okay, I'm 5,000 of this. How do I do it? It's going to be annoying to do it 99 shares at a time. And that's where the algos come in and they're using them to slowly sift them out. And don't kid yourself, the algos will speed them out there 95, 99. But I don't think a lot of people use the odd lots enough. Like it doesn't work on a $2 stock or a $5 stock because, you got too many shares. But on like $1,000 stock, odd lot the crap out of that, and then you don't have to be moving and the price isn't moving against you. Consolidated quote isn't changing with your offers. Maybe you're, sometimes you can go in the regular session, you can throw an odd lot 2/3 of the way down, or even do a midpoint price execution.
Yeah, that's what I was going to.
Where you take them to the mids. But if you start showing some heavy size, they start figuring out, oh, we got a whale here, and then they start pushing it the other way on you. Don't kid yourself. High frequency traders will seek you out. If you're a whale, if you got a huge position, you got $1 million worth of deckers, and you're trying to execute, they're trying to make money off you. So don't show your hand.
What's the market right now? What's the market right now?
10. So it's 108.88 to 13.80, but there's odd lots. There was an odd lot at 110.10. It just got hit 10.10. Right now there's an odd lot. So it's showing 1,000 only, but there's a bunch of odd lots. 1,008.88, 60 shares. 1,007, 25 shares. 1,003 has 5 shares. So there's some stuff in there. So you're 13 points wide, but there is some odd lot stuff.
I'd go in the middle. If I was long 98 shares, I would, whatever the bid and offer is,
middle it.
98 in the middle it. And if they lifted me, I'd be
They don't lift you, get the hell out. You can't just sit it out there and chase it down. Like what a lot of people do is they throw 100 shares and they're chasing and then they're pushing it lower on you. Like, why can't I get done? They're screwing me, and they are screwing you because why are they screwing you? Because you're showing your hand. I mean, one thing that I do very well, and we did do a lesson at PreMarketPrep.com on order execution, an entire 3 hours. It was one of those that we were selling for $99, the lesson. But I have a whole thing. Like, I mean, spend $100 to get better order execution. It's unbelievable. So we have that at PreMarketPrep.com, a whole lesson on order execution, talking about, stupid things that people do. The main thing is just high frequency traders are out there trying to figure out what your orders are. If you just flat out show them, they're laughing. I mean, they're trying to figure it out just from your execution styles, and you're trying to conceal your order intentions here. I mean, you've got to do that because otherwise they're going to blast the things on you when you're trying to buy, and they're going to nail the things on you when you're trying to sell. So you just got to be cognizant that there's a lot of sharks out here, and if you're just flat out showing your orders, they're going to make you pay.
All right, let's get back to the earnings. We had a couple other companies report last night. Let's go to ROST Stores, which reported, this is kind of your like discount retailer, similar to a TJ Maxx, a ROST Dress for Less. You can buy some. I find some good stuff at ROST sometimes, but ROST reported EPS of $1.46, beat by 10 cents, revenue of $4.9 billion. Wow, that sounds like a lot for us. Beat by $70 million. Let's see. So the guidance raised the fiscal year 2024 guidance. Stock getting a pop this morning, trading up about $9 or 7%. So again, like a lot of these retailers looking pretty strong. Ross is close to all-time highs, it looks like, on the if you go to the monthly chart here. So nice little move for Ross here. I'll let you guys take it away, and I've got some more thoughts. Maybe I'll fill in at the end.
Well, Ryan Craver we just had on the show. And Ryan makes some fantastic calls and identifies those trends. He's a retail expert. And what's he talk about is the the discount retailers, right? Like ROST, TJX, Burlington. I mean, all those stocks are doing well. One, it's a trade down effect. You don't have to pay the higher prices. You get the name brands at cheaper prices. TJX made new all-time highs, just yesterday. Obviously sold off with the overall market. Ross Stores is not far from all-time highs. It's these kind of stocks that have been performing very well, not just today, not just last week, but for the last 10 years. Off price, like you're getting, 50% off from your Ralph Lauren shirts, at TJX. I mean, there's just been a consumer trend towards these stores. Burlington is another one. BURL has come off and it hasn't done nearly as well. Maybe they haven't figured it out, but it's still been, one of those grouped in there. But TJX, Ross Store has just been unbelievable performers.
I got one number for you, 142.50. That is the area of a daily high where I put the line, and you also got the pre-market high there. So there you go. There's a good target. You've leaked off it $1.30, but if you're looking for more on the upside, boom, clear that 142.50. Coming back on the downside, I'm horrible with this. I would say, well, the gap's way down here at 132.86, but I don't think we're going to be filling that gap.
So with Ross, and it's kind of similar to Elf, where they're the, kind of the more like cost conscious. If you're trying to save money, you can go to it. The way I see it, and it's probably not this simple, but whether the economy slows down or not, couldn't you say that these companies will benefit either way, right? Like if the economy stays hot and like companies are growing, sure, Ross and Elf will probably do well. Or if people start cutting back on spending, I'm not saying these stocks will go down, but they'll probably go down less than some of their more expensive counterparts. And to that Elf point, I mean, we had the I forget who used to run Estee Lauder, but his whole like lipstick index thing. When people are down on money, they'll still find money to buy, a nice like $3 or $5 lipstick. And so I think things like Elf could be defensive in an economic downturn. And Ross, I would put in that camp as well. Again, I wouldn't say that the stocks wouldn't go down, but I think they'd go down less than like a Ralph Lauren or some of the more expensive counterparts.
They're hitting the nail on the head here, and it's why stocks like TJX, if you just look, it gets little pullbacks. Yeah, COVID, it got hit, but it's just, continues to outperform because it works in both types of markets. And, to your point here, you obviously, in an expansion, all retail does well. In a recession, the trade down happens and they go to these stores. The consumer goes to these stores. These stores just do well. And again, it's like we talk about recessions, expansions. Well, half of the US is just paycheck to paycheck. So they're in an eternal recession here. So that's where the consumer goes to these stores. The trade down is there for the middle class, happening, but those are regular customers. 50% of the population is probably regular customers of TJX always. Doesn't matter if an expansion or recession, they're paycheck to paycheck. So they're always going to be those customers there. That's why these companies just continue to do well. Now, Burlington, again, we used to talk about Burlington the same way as TJX. Maybe management, mismanagement. Big Lots was another one, and that's just complete mismanagement. We know that and what's happened there. So there is stories of mismanagement, but overall, the off-price retailers just continue to perform in all markets.
Yeah, the other thing, we talked about when Home Depot's reported earnings and Lowe's a couple weeks ago. I kind of see it similar in that because, all right, when people are buying more homes and stuff, that's a tailwind for Home Depot and Lowe's. People got to buy more stuff to do projects and stuff. But when mortgage rates are highs and people aren't buying new homes, people are more prone to like fix up what's going on at their old home. So I think, Home Depot, maybe a little bit less so than the discount retailers, but I think can do well in uncertain economic times.
Well, and you can go to like an AutoZone, for instance, too, if you want to talk about people aren't buying a new car. They're going to come out and they're going to, fix up their old car. They need auto parts. Why O'Reilly Auto Parts continues to be an outperformer. AutoZone's another one we know guaranteed. And then you can say Advanced Auto Parts isn't participating. Well, that's been worse to breed. That's a management issue. That's not because, people aren't buying more auto parts. So all this stuff applies. And I mean, those are the kind of companies you want to own, not owning, worst of breed in your sector, though, which is AAP. But the AutoZones and the O'Reillys has been unbelievable stock.
They're so nice,
very long time.
O'Reillys. They're so nice there. I've had a couple small things. I needed a new headlight. I go over there. They get it. They help me. I'm like, can you help me put it in? They put it in. They're so nice there. But it's guest time. Aaron, who do we have on deck here?
We've got Cameron Dawson hanging out backstage. I see her. So let's go ahead and give her our very special pre-market prep welcome and see what Cameron's been watching when we get back.
Cameron Dawson, New Edge Wealth Chief Investment Officer. How you doing on this 3-day weekend coming up?
I'm wonderful, thank you. How are you guys?
We're doing good. So, you come out, if you guys don't read her newsletter that comes out every Friday, it always has a music theme, right? And I like the genre of music that you listen to, a bunch of different things. Have you ever considered if we have like a really bad day today? Like we had a bad day yesterday, okay? Let's say the Dow's died and market's down like 2,000 points. Would you ever go like AC/DC, like Highway to Hell or something like that?
I would, except for the fact that Jeff Gunlock used that as like a big presentation of his a few years ago. And so I feel like he now has ownership and rights, which means that this week I did a Coheed and Cambria themed one, which if anybody likes sci-fi metal, I'm your gal.
So what can you already thinking about it now, or do you wait for the price action today?
Usually it's the price action. So we'll see. I mean, I was thinking of the song Tickets to My Downfall when I was looking at the bearish engulfing that we had yesterday, because boy, oh boy, that was an interesting move.
Let's talk about that move. I mean, everyone's feeling all great about Nvidia. They don't care about the Fed. Talk about investor psychology and like, well, that day's over with now, but how did long term, how do you approach, the next day, the next week, the next month?
Well, I think that we have to pay attention to yesterday's price action. There was something similar that happened in July of last year, this idea of an outside reversal, or called a bearish engulfing, which just typically signals some kind of trend change in the market over a shorter term period. It doesn't mean that the longer term bullish uptrend is over. It doesn't mean that you have to run away for the hills and hide under your bed, but it does mean that be expecting of a little bit more volatility. That July bearish engulfing that we had was right before we saw kind of the swoon in August, September, and October. And so I wouldn't be surprised, given the price action yesterday and given some of the leadership dynamics within the market, so looking at things like cyclicals underperforming, that we could be in a period of a bit more of digestion. Now, we typically see volatility as opportunity to buy and to add if we're underweight equities, or to reallocate to areas where we're more constructive. And I think having those price levels in mind, I think that we'll look at the 50-day, the 100-day, and how we interact with those to see if a test of the 200-day is possible.
Okay, you said some awesome charts here, and there's a lot of them. So once again, we're going back to the interest rate theme, right? What's the Fed going to do? When are they going to do it? Are they not going to do it? Are they going to raise rates? So I can pull up the 2-year Treasury stuck in a range. That's what I've been thinking about. But you tell me what chart. I got the 2-year up here, but if there's one that illustrates your point better, you just let me know and I can move them right along.
Yeah, I think if we're talking about the Fed, the 2-year is exactly what we need to be looking at. And we think that the 2-year is going to be stuck in an elevated range, somewhat around 4.5% to 5%. And the reason for that really tight band is that we think it's hard for the 2-year to move a lot more over 5% unless we see a meaningful reacceleration in inflation, which requires the Fed to, or puts rate hikes back on the table. A hike or a rate above 5% on the 2-year effectively is saying that the Fed is only going to do 1 or 2 interest rate cuts over the next 2 years. So much above 5% is effectively pricing in further hikes. And we do think the bar for further hikes is far higher than the bar for cuts, meaning the Fed will react to weaker employment data far faster than they will react to hotter inflation data. So that keeps the 2-year in this elevated range. The inflation data is not soft enough for them to suggest that they need to be cutting, but it's not hot enough to suggest that they need to be hiking. And so we're stuck in this high elevated range. Then if you go to the 10-year, that's where we continue to see the 10-year is in an uptrend. And as much as people are trying to call this is the end of the yield cycle and yields have hit their highs for the cycle, we just note that it pulled back to support and it is moving higher now after yesterday's hotter PMI data. So yes, it was a lower high than we had back in October of last year, but we would not rule it out that we could retest at least the April highs that we had, simply because this uptrend remains in place. And you have a lot of dynamics about some areas of hotter data, of course, some areas of weaker data. We could talk about economic surprises, but then we have Treasury funding to contend with and all of the deficit talk going into the election. So, we're still in the camp that the 10-year is effectively in an uptrend.
Cameron, what does that mean for broad market? Not talking Nvidia, not talking the AI trade, but talking consumer cyclical, small caps, even going to the staples, utilities. If we're going to stay higher rates for longer, what does that mean for those stocks?
It's fantastic for the big cap tech names because they're sitting on so many cash balances, and higher for longer is great for them because they earn a big return on their cash and they can either use it to increase dividends or buy back shares. It's terrible for companies that have to refinance their debt. And if you go back to the Russell 2000, you had a massive Russell 2000 rally in November and December of last year based on one thing and one thing only: falling interest rates that would relieve pressure off of the balance sheets of these companies that have a lot of floating rate exposure, as well as have just very high debt levels that will have to refinance. As we stay higher for longer, those are the areas that are going to continue to get pinched because they're not going to be bailed out by the Fed, which is no surprise as to why the Russell 2000 made a new relative low yesterday. As interest rates moved back up, as you had all the commentary from the Fed talking about higher for longer, no rush to cut rates, we need to see more evidence. All of that suggests that those with bad balance sheets will continue to lag. The caveat to that, though, is just be very aware you could have very powerful counter trend rallies that just rip in your face because they're under owned, because it's now consensus that you can't own small caps because of balance sheets. The rally that we had back in November and December was absolutely just eye-popping. And I wouldn't be surprised if that happens again, mostly because you've seen people give up on the area.
Cameron, how quickly could this change, the outlook for interest rates change? Because I mean, if we report, say, not great economic data numbers for 1 month, I don't think the Fed's gonna get in front of it and say, oh, we need to start cutting because unemployment went up. But do you think it would have to be a 2 or 3 month period showing a slowdown and inflation falling before they started cutting? What would that look like?
Yeah, it is a good question of what is the piece of data that would push them over the edge, because it's not been things like delinquency rates. We've seen those spike up really materially as if we're already in a recession. We think it really comes down to non-farm payrolls. If you were to see a negative non-farm payrolls print, it's good to remember back in 1995 when the Fed cut interest rates, there were a few negative non-farm payrolls prints, even though it was a soft landing cut and everybody looks back and said, oh, the economy wasn't bad. The Fed just kind of tweaked policy rates lower. No, you had a couple months where it looked touch and go, and that's why the Fed cut rates. So we wouldn't be surprised if you saw weaker non-farm payrolls. To kind of put a pin on that one as well, if you look at last month's non-farm payrolls, you saw a big deceleration in cyclical parts of the jobs market. So things like leisure, hospitality, construction, all of those areas saw a big, huge slowdown versus the prior month of job additions. If that continues, they didn't actually shed jobs, but they just slowed a great deal.
Right.
It's if we get into the shedding of jobs, that's where the Fed will have bigger concern.
Cameron, you got a word up here. I'm going to share my screen. People don't like a very naughty word on Wall Street here, and it's bearish. S&P bearish engulfing candle here. I'll pull it up. And so let's talk about that, the bearish engulfing, how the breath looks. And let's talk about the equal weight S&P top relative to the bottom separation.
Yeah, I mean, the interesting thing is, for as much talk as there has been about this broadening of the rally and everything is great and awesome, equal weight continues to be left in the dust. And so we did see more names trade into better uptrends over the last month or so when you saw the breadth expand, so the percentage of names over their 50-day. But even while that was happening, the equal weight index started to make new relative lows, which just means that this is a market that's like back to its same old ways of being very top heavy, very tech focused. Tech is the only sector that is trading to a new relative high, of course, helped by Nvidia and the big weight that it has. And it just means that everything else is kind of being left in the dust. This isn't great from a risk on perspective. It doesn't mean the end of the world, but it does suggest that this is not nearly as bullish of an underlying market as maybe the headlines would suggest.
And about the golfing pattern here, is it something we need to take note? What would complete the formation?
Yeah, I think that it's something to take note. As we talked at the start, is that oftentimes a pattern like that, an outside reversal, is indicative that there's some kind of sea change in the trend happening, and really going back to the one that we had back in July. It doesn't mean you immediately collapse. You could have a couple days like today, futures are indicating higher, but it does suggest to us that a retest of the 50 or 100-day moving average is certainly in play, given that engulfing pattern.
Let's jump and take it back to the tech stocks, and I just want to get your thoughts on the AI trade in Nvidia here, because it was an impressive move here yesterday. You have Nvidia making new all-time highs. Is this a bubble? Is this AI trade a bubble here? Is this just, because other things aren't working as well, everybody's just crowded in here, or is this a whole AI trade for real? Because obviously we've seen separation here happening. 2024 has been driven by Nvidia and the AI trade. Yesterday was interesting because he had separation where Nvidia was up, but AMD was down, SMCI was down here. Thoughts on the AI trade and Nvidia?
Yeah, I think that Nvidia is a little bit of a different case than a lot of the other AI tangential areas, because it's seen such huge re-rating in its earnings estimates, which just means that as we all know, the multiple for Nvidia actually fell over the course of the last year because earnings estimates went up so much. What's different, though, for a lot of the other semiconductor names is that, yes, they've had their earnings estimates be revised higher, but not nearly to the extent of the upside that you've seen in the stocks, which means you've seen it built on big multiple expansion. The same thing can be said for things like utilities, which really got this idea of being beneficiaries of AI. So a little bit of re-rating in their earnings estimates, but then saw a much larger portion of the upside in the stocks driven just by multiple expansion, just by euphoria, just by optimism. So what I'd say is follow the earnings. The next question to ask for Nvidia is if they are over earning, and if that earnings pace that they have is sustainable. Remember, semiconductor companies are incredibly cyclical companies. The thing I'd say, though, is that the semiconductor cycle broadly still looks to be in early days of recovery. Semiconductor sales overall are still below the 2021 peak. We've never seen a semiconductor cycle stall out and not make a new higher high in its sales growth, which just says that, yes, expect volatility. The stocks are going to move ahead of themselves, but it does look like there is an overall semiconductor cycle happening. So be disciplined and not chase big, huge rally and overbought signals, but that probably oversold signals can be used to buy. The one thing I'd note, Renmac, Jeff DeGraff has been flagging this, is that option sentiment still remains really, really frothy within the semiconductors. And Jeff is just a fantastic technical analyst and says, look, it's not enough to be fatal, but it is enough to get your attention to say that people are incredibly bullish. So to get to your bubble question, Dennis, is that could be a sign that there is over exuberance.
So Cameron, right now, I mean, it seems like people and the Fed members especially are still worried about inflation. I saw some data yesterday. Let me go ahead and pull it up. This is like CPIs from all across the world. So in the yellow here, you have UK. The white one is here in the US. And it seems like inflation all around the world has been falling steadily, but still not really below that 2% or at that 2% target rate. Like, do you think we're going to hit a point here in the next few months where we're not as worried about inflation as we were? Do you think that'll still be the chief concern of the Fed members and what people here in the US are worried about?
Well, I don't know if it's been a chief concern for the market, just because the market has been able to shrug off a tighter Fed and higher interest rates as the Fed has been more hawkish than expected, because the market's been focusing on growth and not inflation. And we think that the most important chart to watch is the GDP growth forecast for 24 and into 25, because if those continue to be revised higher, a lot of things can be forgiven. If they start to be revised lower, then you start to have bigger issues and concerns and questions about the growth story. Then you really question equity valuations. You question where credit spreads are going. From an inflation standpoint, you do have a lot of evidence that the progress on inflation, at least in the US, has certainly stalled, where if you look all year long, we've been stuck in this high threes range and haven't continued the deceleration that we had over the course of the prior year and a half, which just says that there are still underlying inflation dynamics that don't get us back to the pre-pandemic level. The question is the Fed okay with that? Remember, they did something called average inflation targeting back in 2020 at the Jackson Hole meeting, which said, oh, we'll tolerate higher inflation. I'm not saying that they're going to get rid of the 2% target, but now they're starting to talk about a neutral rate being above 2.5%. That was something that Bostic talked about this week, which suggests that, maybe we could see some discussion about longer term targets, mostly as we get to Jackson Hole, which is coming up in August.
So basically, you're saying that the 3% or 3% inflation rate's not too big of a deal as long as we have that economic growth on the back end, and if that goes, then it's worrisome.
Yeah, then it looks a lot more staggy, right?
We don't want staggy. We don't want that.
Yeah, if you don't get the growth underlying, then you do have an issue that inflation remains elevated. Because if you're not getting the growth, you're likely also not getting a strong jobs market, and you're going to see consumers continue to get pinched with real wage growth decelerating. That's what we've been seeing, is real wage growth has stalled out in its improvement, and that explains a lot of the weakness within consumer sentiment. The one chart that we continue to watch the most, if you say the most important economic chart is GDP forecast. The most important market chart is the relative performance of consumer discretionary versus consumer staples on an equal weight basis. This ratio has an incredible ability at sniffing out turns in the forecast for household consumption, which just means that the equity market does a great job of seeing when the consumer is fraying and when it might need to have estimate revisions be lower. This ratio is sitting right at trend. It is pulled back right to trend. It's not enough to call it a change in trend to a full-on downtrend, where discretionary, a cyclical sector, is now underperforming staples, a defensive sector. But it certainly should be a chart on the radar, because if that does change trend, it changes the growth regime, it changes the risk appetite regime, and it likely changes certainly what kind of stocks are leading in the market.
One more thing before we let you go, Cameron. Commodities here, right? The driver of inflation here. You have a nice chart here noting that commodities are moving out of a downtrend here. So just have the index up here. I guess that little bit longer term, that has to be concerning.
Well, yes and no. So yes, it can be, because it feeds into higher non-durable goods prices, meaning that things like food and energy prices go up. And we saw that back in the 2000s. We had a big commodity super cycle. They doubled in prices. The BCOM went up by over 100% over the course of 2000 to 2007. The caveat there is that durable goods, so things like home furnishing, electronics, appliances, those prices still continue to fall, even as you were starting to see input costs go up rather materially. What this is to say is that globalization and technology were more important for durable goods prices than input costs were. I think a good question to ask is that if we're moving into an environment where you see less globalization, do you get the same kind of durable goods deflation like you had during the 2000s? Or do you see commodity prices actually filter in and be a more inflationary driver of those prices? Then, of course, you have to think about, this world of AI and services inflation versus disinflation. But I think it is an interesting plot twist here, given the fact that everybody thinks inflation is dead and yet copper's roaring. Oil isn't. Oil's sitting out of that. And I think that would be the big missing piece to see the commodity complex feed into inflation.
All right. We have just covered just about everything here with Cameron Dawson from New Edge Wealth joining us here, Chief Investment Officer, doing just a great job for us. We really appreciate it, and we'll have you on again real soon.
Thank you, guys.
All right. Thank you, Cameron. All right, guys, we've got about 5 minutes left of the show, last show of the week. Again, market will be closed on Monday. We're not going to be doing any streams unless Joel's going to do his special solo show.
Joel often wants me to do it because Canadian markets are open. So
yeah, there you go. You guys
but I'm not doing it. It's my day off.
Spoos are open Sunday night. Sunday night.
You go.
They'll be
Joel,
open.
Get on there, cover that.
From Sunday until 1 p.m. There's some good moves sometimes. Sunday until 1 p.m. But come on, you got to take a day off.
All the stocks we've talked about today have traded higher. We talked about Deck, which is up on earnings. We talked about ROST, which is up on earnings. Let's get to the not so great
show.
Well, yeah, let's get to the not so great. We'll leave that for the back half of the show. So let's talk some Live Nation, which went down yesterday more than 7.5% on news that the DOJ is filing an antitrust lawsuit against Live Nation, which of course not only owns concert venues across the nation, but also owns Ticketmaster. And this has been, in the talks for a while. And I think, a lot of people assume this was coming, but on the announcement, did hammer the stock a little bit. And I mean, I'll let you guys give your thoughts, but just saying that out loud, that they own the concert venues and then also Ticketmaster where you buy the tickets, that right there,
it's ridiculous.
That right there, I mean, that right there is an antitrust lawsuit in its own, let alone whatever else they're doing. That alone, it warrants an antitrust.
And they got the Swifties behind them too here. All the Swifties.
That was the catalyst. So. Yeah, that was the catalyst.
Yeah. Oh yeah. She's a mover and a shaker. There's probably nobody more powerful in that world than Taylor Swift here, and she's at you. Look out, the DOJ is listening here. So I don't know what to say. Live Nation, they still have the basic monopoly on all of this. What they do, they look under investigation for these companies, sometimes for years, and then they slap them with a fine or something, Joel. At the end of the day, are they going to make and break this company up? Probably not. Does the company continue to have its monopolistic powers in whatever way, even if they had to break them up? Probably. So I think if you're saying, this is the end of Live Nation, this is the end of Ticketmaster here, I think it's probably not. It's probably not.
You had the news yesterday, closed near the low, getting a little bit of a bounce. I'll just try and look at this technically. This did move up from its, I believe it was earnings, had a nice run. So let's see if they defend that earnings gap low at 92.30. Didn't quite get there yesterday. So after that, then you got to be looking at $90. But a lot of times you get this news, there's a big reaction in the market, and then you don't hear about it for a while, and the stock just kind of drifts back. Also, I don't know what the DOJ's record's been lately, but I don't think it's very good these days.
If Live Nation did have to divest Ticketmaster, sell that complete thing, who could be a buyer of that? I'm just trying to think. Ticketmaster, didn't StubHub used to be publicly traded, and then that's all.
I don't think so.
They don't even want them to be the buyer, though. They don't want them StubHub.
I don't know, or maybe I guess could do they ever have to?
I think they just spin them off and they're doing their own thing there. Okay. But there's still obviously all the connections to it, so it's a hard thing to break up monopolies. I mean, they've been trying to do it on Google, and Google's obviously Google, but I mean, for 20 years, 10 years at least, they've been, just attacking Google, all antitrust, attacking Google, attacking the mega caps, and they slap them with fines. There's just, it's hard to break them up.
All right. Other stock in the not so great news yesterday was Workday reported earnings after the close. Failed to impress investors with the earnings. Let's get those numbers up here. So EPS came in at $1.74, beat the $1.58 estimate. Sales came in at $1.99 billion, beat the $1.97 billion estimate. So both those numbers were good, but it lowered full year sales guidance, which can't do that. Can't lower your full year sales guidance. Stock trading down about 10% this morning.
Yeah, tough. Joel's going to be silent here through his whole, because he likes that Workday joke there. He'll pretend he's on.
No.
I was ready for it, though. I was ready for it this time. You're like a broken clock. I know what the heck's going on over here. Break it down, new lows. Awful night to report because they were just had their selling shoes on and all tech stocks. Intuit, same thing, really getting hammered here. I mean, valuations are stretched. Growth isn't what it used to be here. So there's some issues here. With that being said, it's still a company that, has a good name. People like buying the dip on this, but I think I'd wait again to buy strength after the report as opposed to buying the weakness.
Well, if you've been waiting for a gap fill here back since December, you're getting that and then some. That came at 237.63, the gap fill. And then the low on that day, I don't know, this is an interesting little pocket here. If you feel like you want to own this thing over the next couple days, see what it does with this 5-6 days of congestion here between 233 and 236. It was an area where it stopped before, so let's see if it finds stabilization here. You did break down, though, out of a major range. So see, you know what, they just like these stocks. Like, what was the stock the other day that, it opened low? Oh, like, I don't know if you're going to get a Palo Alto Networks out of this one.
Doesn't have the name, doesn't have the strength. And I bought that Palo Alto dip just in my long-term portfolio because the stock I wanted for a while. And I was like, the report wasn't that bad. But Workday, not best of breed in their sector. I mean, got a good name. It's a spinoff from Salesforce. I'm kind of what I'm building my portfolio is buying best of breed names on these dips, like just trying to because that's what continues to work. Even to Cameron's point, she made some excellent points through there, but she also made the point, this environment that we're still in, higher rates for longer, continues to work for the mega caps, continues to work for the big tech names. Because they get money no matter what. Even to AB's point, talking in the retail sector, and I'm, just making a comparison here. There's certain stocks like TJX that just work in all environments. Well, Nvidia works in all those environments. Palo Alto probably continues to work in all environments, recession or recession. Hacks aren't going away. They're only going to continue here, especially as, the world, this becomes more technical. And think about AI and everything. It's going to be more hacks, more deep fakes, more everything. You need cybersecurity. You need, chips. That stuff's just not going away.
Yeah, if you're a large company right now and you're looking at where to save money, you're not cutting your cybersecurity bill. You're not cutting your, semiconductor. We need these chips. So, look at those spaces where it's harder to cut those costs if you're a company. But all right, guys, it is 9:02 a.m. This has been a fun week. We've had a lot to talk about. Actually, to me, this week was more exciting than the previous week, and we had all the meme stock stuff going on. So hope you guys enjoyed the shows this week. Please smash the like if you haven't already. We do have live trading starting up right now. And then again, no show on Monday. We'll be back on Tuesday, and hope to see you guys there. Any final thoughts, guys?
We're creeping higher here, right off the pre-market high, 05.25. So it looks like they're defending that low from yesterday. Let's see some follow through that pre-market high. And you know what? There's really not much in there because we came down pretty hard yesterday. So if I'm looking for a level of potential resistance here, not much in there. You have a series of closes. I like to look at the series of closes, 53.30 area. But it might be a little early, but I'm going to call this an inside day after that big range yesterday.
You could have that.
What about this, Joel? I'm going to ask you to give me a prediction, a specific number. Not for the market, but for what I'm going to shoot today on the golf course. 18 holes, Rackham Golf Course.
Well, I've never seen you golf.
Okay.
And I've never seen you handicap. You're a pretty good athlete. Not super strong.
Okay.
But golf's all technique. It's all that
94.
whip.
94.
94. All right, I'm taking the under. I'll let you know what I shoot, but I think I can beat 94. Oh, Mike Franz is going
I think AB's an excellent golfer.
Racco's a pretty easy course.
I'm not excellent, but I think I can beat 94. I've played with
I'm a
Jake before
hacker.
in the chat. Yeah,
I try to muscle
we're
every
all
shot.
hackers.
I have no technique whatsoever. I just try to like hit just smack the ball. No technique at all. I need technique.
When we all
Then I'd be
three
a
get
better
together,
golfer.
let's get together this summer because I am very confident that you guys cannot out-hit me in any club in the bag. Driver, 3-wood,
See, Joel's all
iron.
technique. What do you weigh, Joel?
I weigh 180.
Joel's 180. I'm 220. So you'd think naturally that I'd be able to out-hit him because I just have 40 more pounds of force going into these balls. But it's not the case because I have no technique. So I guarantee you're going to out-hit me. I suck.
Rustic will say
I can only get out like 3 times a year or two.
Grip it and rip it
Rustic
is my motto.
Yeah, that's a good
You know
motto.
what killed my golf game the most? 10 years ago. Having kids. Yeah, I love my kids. They definitely killed my golf game. I used to get out before I had kids like once or twice a week. I'm like, oh, I'll go have a beer, hit some balls. What are you doing this afternoon? Or what are you doing tonight? I'm going to hit some balls. It's going to be good. Now it's like, oh, I got kids.
You know
maybe
what?
the kids get older. I start golfing with the kids, though. So maybe
they
it's
should
just coming
change
into
it to 16 holes or something because like 18 holes on a Sunday afternoon when it's 85 degrees out, the only thing I'm thinking about is being in the pool. And having it's just too hot. But
all right, guys.
Great job today. No, I was just gonna say, great job.
Good luck on the course.
Good
luck with your parlays
on the
this
Indy
weekend.
500. Any Indy 500 predictions? No.
Willpower. If he's racing, I'm taking.
I'm going with Willpower as well. That is just the best name ever.
Willpower. We're going Willpower.
Long Willpower.
Long Willpower.
Okay, Triple D. Wait, before you go, Triple D, I'll be calling you at 9:45. So get out of those opening trades. Okay.
All right, guys. We'll see you on Tuesday.